It is 7:15 on a Wednesday morning. Rajan, 49, is in the queue at Jurong West Hawker Centre. Kopi C, Kaya Toast. The same plastic stool for 11 years. Last night, he opened his CPF statement. He earns 7,500 Singapore dollars a month. Senior IT manager. He is not rich. He is not struggling. He thought he understood money. He has been paying into CPF since he was 25. And last night, staring at that statement, he realized he has almost no idea what he actually agreed to. Because what he saw was not a savings account, it was not a pension fund, it was something that exists in no other form, in no other country in the world. A system so specific, so structured, so total, that if you tried to build it in Germany, Canada, Australia, or the United States, lawyers would be in court before the ink dried. Today, we look at exactly why. Start with a number that explains everything else. $7,500 a month. Before Rajan sees a cent, $1,500 is gone from his salary. His employer contributes another $1,275 on top. $2,775 every month into CPF. 37%. Compulsory. No opt-out, no exceptions. Now compare. In the United States, Social Security takes 12.4%, combined, employer and employee together. Americans protested constantly. In the UK, national insurance at the combined rate sits around 25%, and you receive a universal state pension regardless of how much you put in. In Germany, statutory pension contribution is 18.6%, split equally. In Australia, the employer-only superannuation guarantee is 12%. Singapore's 37% is not just the highest in the developed world, it is in a category of its own. Double Germany, triple Australia's employer share. Almost exactly 3 times what Americans pay into Social Security. And that is just the entry point. Rajan started working at 25. If he works until 63, 38 years, $2,775 a month before interest alone adds up to $1,263,000 contributed into one account with one rule. You do not choose what happens to it. That is not a pension. That is something else entirely. Here is the mechanism that would trigger legal challenge in most Western jurisdictions the moment it was proposed. In Australia, when your employer puts 12% of your salary into superannuation, that money is yours to direct. You choose the fund, you compare performance, you switch if you find a better option. There are over 100 competing superannuation funds. You can invest in equities, bonds, property, balanced portfolios. The best Australian super funds have delivered 7 to 9% annual returns over 20-year periods. Members with better funds retire with proportionally more. Competition works. In Singapore, there is one option, CPF board, full stop. No competitor, no alternative. Your 37% goes into one government-administered system, and it is invested in one asset, special Singapore government securities. Non-tradable bonds issued exclusively by the Singapore government to CPF board. No market exposure, no competition, no choice. In the European Union, a mandatory single provider savings scheme with zero member choice would face immediate scrutiny under multiple frameworks. The Directive on Institutions for Occupational Retirement provision, the Freedom of Capital movement under Article 63 of the Treaty on the Functioning of the EU, and straightforward competition law. The moment you mandate that citizens must contribute to one government entity with no alternatives, you're in territory the EU has been specifically legislating against for decades. Not because the EU thinks the government is bad at investing, because the legal principle is that consumers in a free market must have choice. Wei Ling is 55, senior accountant, Bedok. $380,000 in CPF accumulated over 30 years. She has done her reading. She knows that VWRA, the Vanguard FTSE All World UCIT SETF, domiciled in Ireland, has delivered roughly 7 to 8% annually over the past decade. She knows that Irish domicile means 15% dividend withholding tax instead of 30%, no US estate tax exposure, expense ratio of 22 basis points. She wants to move $200,000 into VWRA through her CPF. She cannot do it. She can invest through CPF-IS, the CPF investment scheme, but only in approved products, only after leaving $20,000 untouched in OA, and only if she can beat the baseline rate of 2.5% after fees. Most people who tried the old CPF-IS approach did not beat it. MAS data showed that a significant proportion of CPF-IS-OA investors historically underperformed 2.5% once high-fee unit trusts charging 1.5% to 2% in annual management fees were factored in. CPF Board reformed the approved list in 2018 and 2019. The options are cleaner now, but the fundamental constraint has not moved. Wei Ling cannot simply redirect her CPF savings to the investment she believes is best for her retirement. In Australia, she could do this without asking anyone. In Canada, she could. In the United Kingdom, she could. In Singapore, she needs permission. And the permission comes with a list. Now, Rajan needs to understand what cannot touch actually means. Not in theory, in practice. He's 49. He has been contributing for 24 years. His ordinary account holds substantial funds. His special account earns 4% per year. His Medisave is funded. On paper, he has significant assets. But if Rajan needed $200,000 in cash tomorrow, a business opportunity that closes in 72 hours, a medical crisis not covered by MediShield, a family emergency, his CPF is entirely off the table. Not mostly off the table. Not complicated but possible. Entirely inaccessible. Legally. His special account cannot be withdrawn. His Medisave is locked to specific approved medical uses only. His ordinary account can only be used for housing, approved insurance, CPF-IS approved investments, or education loans. No other purpose exists. Until he turns 55, there is no legal pathway to take a single dollar in cash, unless he is certified permanently unfit to work or has a terminal illness diagnosis. This is not a savings account in any conventional sense. The money exists. His name is on it. He watches the balance grow every month. The state controls how and when he may use it, and it controls the purpose. In Canada, Section 7 of the Charter of Rights and Freedoms, the right to life, liberty, and security of the person, has been invoked in cases far less restrictive than a 40-year lock on personal property. In the United States, the constitutional debate around mandatory Social Security contributions has never died, but even Social Security is fundamentally different. It is a pooled system with no individual account, no your name on it balance, no illusion that the money is personally yours. CPF creates exactly that illusion. Personal account, your name, your balance growing, and then denies access for 3 to 4 decades. That specific combination does not exist in Western legal frameworks because no Western government has tried to create it. CPF is a personal account that is not personally accessible. That sentence alone would require new constitutional interpretation in Canada, new legislation in Germany, and a Supreme Court case in the United States that no one has been brave enough to bring. Here is where it gets complicated and more interesting. Rajan turns 55 in 6 years. He has been waiting. That is when access begins. Sort of. On his 55th birthday, CPF Board automatically creates a retirement account. Savings from his special account transfer in first, then from his ordinary account if needed, until the retirement account holds the full retirement sum. In 2026, that sum is $220,400. That amount stays locked until 65. So at 55, if Rajan's combined OA and SA balance is exactly $220,400, he receives $5,000 in cash. The $215,400 remaining, his money, accruing for 30 years, waits another decade. Wei Ling turned 55 last month. She had been counting the days. Her advisor explained the calculation. Her balance sat at $240,000. She could withdraw $19,600, the excess above the full retirement sum, and nothing more until 65. She spent 4 days not speaking about it to her husband. In Australia, once you reach preservation age, between 55 and 60 depending on birth year, and meet a condition of release, the money is yours to withdraw fully. In the Netherlands, pension funds are also locked, but they are defined benefit schemes, structurally incomparable, built on a completely different promise. What does not exist in the Netherlands, or Australia, or Canada, or the UK is a defined contribution personal account, where your name is on it and your contributions are tracked individually, that you still cannot access after age 55 in meaningful amounts. That specific architecture is unique to Singapore. The world has locked pension funds. The world has accessible savings accounts. Singapore built something in between, and then applied the rules of the locked fund to the structure of the personal account. Now Rajan needs to understand the mechanism that surprises people most, the one nobody explains at the point of sale. David is 57, logistics supervisor, Ang Mo Kio. He bought his Bedok 5-room HDB 20 years ago for $310,000. He used his CPF ordinary account for the down payment and every single monthly installment across 2 decades. Total withdrawn from OA, $212,000. He sells this year for $760,000. He has been doing the mental arithmetic since he signed the option to purchase. $760,000, loan already cleared, should give him $600 and some change after fees and stamp duty. The statement of accounts arrives from his conveyancing lawyer. CPF principal refund, $212,000. CPF accrued interest refund, $103,000. Total return to CPF, $315,000. Cash received by David, $431,000. The $103,000 is not a fine. It is not a penalty. It is the interest his CPF ordinary account would have earned at 2.5% per year, compounded over 20 years if the money had stayed inside CPF instead of paying his mortgage. The system calculates the opportunity cost of using your retirement savings to buy your home, then charges you that opportunity cost when you sell. The money returns to his retirement account. It will pay him CPF life income from 65. David understood this rule existed. He had not run the actual number before that moment. Rajan reads this story on a finance forum. He opens his CPF housing withdrawal statement to check his own accrued interest figure for the first time. He closes the app. He opens it again 3 minutes later. This mechanism, mandatory return of notional interest on your own housing withdrawal to your own retirement account at point of property sale, does not exist in any other country on earth. Not one. Not Canada, where you can use RRSP savings for a first home purchase under the Home Buyers Plan and repay over 15 years without any interest. Not Australia, where super cannot be used for housing purchase at all, except in very limited first home super saver contexts. Not the UK, not Germany, not Malaysia, not Hong Kong. The accrued interest rule is entirely, irreducibly Singaporean. You could not transplant it to any other legal jurisdiction without rewriting property law, contract law, and retirement legislation simultaneously, which is precisely why no one has tried. There is a calculation that most Singaporeans have never done. It takes about 90 seconds, and it changes how you see the system entirely. CPF Board invests all member contributions in special Singapore government securities. These bonds are guaranteed by the Singapore government, among the highest credit-rated sovereigns in the world. GIC, the Government of Singapore Investment Corporation, manages those proceeds alongside other government funds and invests them globally in equities, bonds, real estate, and private markets. Over the 20 years ending March 2025, GIC's annualized return was 5.7% per year in US dollar nominal terms, 3.8% above global inflation in real terms. CPF Ordinary Account pays 2.5%. CPF Special Account pays 4%. The spread between what GIC earns on your money and what CPF pays you is real. On Rajan's projected total CPF balance, 3.2 percentage points compounding over a working career is not marginal. Christopher Balding, an economist who studied Singapore's public finances in depth, estimated that the average Singaporean who earned GIC's long-term return on their CPF contributions instead of the CPF rate would retire with approximately 850,000 Singapore dollars more. That specific figure is disputed. The methodology has been challenged, but the direction of the gap is not in dispute by anyone who can do arithmetic. The government's explanation for the structure is coherent and internally consistent. GIC takes investment risk on your behalf. You bear no market risk. The 2.5% OA rate is guaranteed even in years when GIC loses money, and GIC has had terrible years. The global financial crisis, extended low return periods after the dot-com crash. The guarantee costs something real. The cost is the spread between GIC's returns and what CPF pays. Up to 50% of GIC's net investment returns flow back to the Singapore government budget through the net investment returns contribution. In financial year 2026, that contribution is 28.5 billion Singapore dollars. It funds schools, it funds public housing subsidies, it funds healthcare. It comes back to citizens indirectly through services. In Australia, the return from your superannuation fund goes to you, directly. No intermediary, no budget contribution, no infrastructure subsidy calculation. Which system is better? That depends entirely on what you value. Individual return maximization or collective infrastructure funding through compulsory capital. It is not a question with a clean answer. It is a values question dressed in financial clothing. What is not in question is that the Australian version would be illegal in Singapore as designed, and the CPF version would require fundamental constitutional restructuring to implement in Australia. Here is the part of the system that does not appear in CPF board brochures. There are approximately 250,000 self-employed persons in Singapore. Freelancers, consultants, sole proprietors, independent contractors, people who built their income outside a payroll system. For salaried workers, 37% goes into CPF every month, employer and employee combined, compulsory. For self-employed persons, one thing is compulsory: MediSave. If your annual net trade income exceeds 6,000 Singapore dollars, you contribute to MediSave. That is it. The ordinary account, the account that builds housing purchasing power and retirement savings, is voluntary for the self-employed. The special account, the 4% retirement vehicle, also voluntary. Faisal is 57, graphic designer, Geylang. He has been self-employed for 22 years. His clients have included banks, government agencies, and half the major retailers on Orchard Road. He has earned good money across that career. He prioritized cash flow in the lean years and kept meaning to look at the CPF top-up options. He never did. Today, his CPF holds $68,000, almost entirely MediSave. His trajectory to CPF life at 65, approximately $530 a month, based on his current RA balance projection. Singapore's average elderly retiree spends $1,384 monthly, according to the Household Expenditure Survey 2023. The gap Faisal faces every month in retirement is $854. Not a rounding error. A structural shortfall that compounds every year he lives past 65. But here is what Faisal can still do. He is 57. He has 8 years before 65. He can make voluntary cash top-ups to his CPF SA, if below 55, or directly to his RA now. Every $8,000 he top-ups per year earns 4% guaranteed and qualifies for tax relief, reducing his taxable income dollar for dollar up to the $8,000 limit. If his income puts him in the 15% bracket, $8,000 in RSTU top-ups saves him $1,200 in tax annually. And at 4% compounding over 8 years, $8,000 grows to $10,957 by the time he is 65. He does not need to hit the full retirement sum. Getting from $530 a month to $950, the BRS payout, is a specific number. The gap is approximately $110,000 in his RA at 65. $8,000 per year over 8 years at 4% gets him to $91,000. Not the whole gap, but it closes most of it, and it is available to him right now on the CPF website. The form takes 7 minutes. Faisal has been telling himself for 3 years he will look into it. The math does not wait. In Canada, the Canada Pension Plan covers self-employed persons at the full combined employee plus employer contribution rate. They pay both sides because there is no employer. Because the policy principle is that income earned is income that builds toward a pension, regardless of employment structure. In Germany, most professional categories of self-employed workers are mandated into either the statutory pension or an approved professional pension scheme. In Australia, superannuation contributions apply when a business pays a contractor more than $450 a month under a labour contract. In Singapore, Faisal spent 22 years earning income, paying taxes, contributing to Medisave, and building essentially no retirement savings in the main CPF system. Not because the system failed him, because the system never covered him. Now back to Rajan. At 65, where the final number lands, he retires having met the full retirement sum. CPF Life Standard Plan. The estimated monthly payout for the 2026 cohort at 65 is $1,780. The Lee Kuan Yew School of Public Policy Minimum Income Standard for a Single Elderly Person, updated from the most recent focus group research as of 2022, is $1,492. The actual average monthly spend from the Household Expenditure Survey 2023 for households comprising only persons aged 65 and above is $1,384. On paper, $1,780 is above the minimum, but the calculation has conditions. It assumes Rajan does not pay rent. His HDB is paid off, which is true for most who used CPF for housing, so he does not. It assumes no major healthcare costs beyond Medisave limits. It assumes his cost of living in Singapore does not grow faster than his fixed monthly income. CPF Life Standard Plan payouts are fixed at commencement. They do not automatically adjust for inflation. Singapore's long-run core inflation averages approximately 2% per year. At 2% inflation over 15 years, $1,780 in purchasing power becomes $1,162 in today's terms, which is below the current minimum income standard, not on the day he retires, 15 years later. He defers to 70 instead of starting at 65. Every year of deferral increases payouts by 6 to 7%. Deferring 5 years takes his monthly payout from $1,780 to approximately $2,360. That is the move that buys him meaningful inflation buffer. If he has income from another source between 65 and 70 to live on while he waits. Which brings us to the parallel structure that the people who retire comfortably always have. Rajan has not maximized his SRS for 2 years. This is the mistake that costs the most per minute of inaction. SRS, The Supplementary Retirement Scheme is the mechanism that runs alongside CPF for people who understand how to use it. Citizens can contribute up to 15,300 Singapore dollars per year. Every dollar reduces his taxable income. At $7,500 per month, Rajan sits in the 19.5% tax bracket. 15,300 in SRS reduces his annual tax bill by $2,983. That money stays his instead of going to IRAS. That SRS balance, invested in VWRA, the Vanguard FTSE All-World UCITS ETF, Irish domiciled, 15% dividend withholding versus the 30% he would pay on a US domiciled fund, no US estate tax, expense ratio 22 basis points, earns market returns with no CPF lock-in mechanism, no accrued interest rule, no FRS requirement, no government bond proxy. The returns belong to him at the rate the market delivers. He withdraws from 63 over a 10-year window, with a 50% tax concession on SRS withdrawals, meaning only half the withdrawn amount is taxable. For Rajan, at his income level, this is the instrument that bridges the gap between what CPF Life pays and what his actual retirement costs. Wei Ling does the same calculation. She stops fighting the CPF rules she cannot change. She builds the parallel structure that gives her the control the CPF rules took away. VWRA in SRS, 30-year Singapore government securities in her cash portfolio for duration and predictability. A deliberate decision about CPF Life deferral, 65 or 70, modeled against her actual projected monthly expenses, not a generic calculator. The people who feel trapped by CPF are almost always people who only look at CPF. The people who retire comfortably almost always built something alongside it. Not instead of it, alongside it. So, would CPF be illegal in most countries? Not one rule of CPF violates Singapore law. It is the law. It was designed here, for here, by a government that built one of the highest home ownership rates in the world, over 90%, and created a retirement system ranked 5th globally by the Mercer CFA Institute Global Pension Index 2025, its first ever A grade, highest in Asia. The system produces outcomes that most developed countries study with genuine envy. But 37% mandatory contribution to one government provider, no alternative, illegal under EU competition law. Single government fund with no member choice, incompatible with Australian and UK consumer protection frameworks. Personal account you cannot access for 3 to 4 decades, would require constitutional amendment in Canada and the United States. Mandatory single provider health insurance with automatic enrollment and no viable exit. Violates the EU Insurance Distribution Directive. Accrued interest on housing withdrawals returned at property sale. Unique in human history. No parallel exists anywhere. The spread between what GIC earns and what CPF pays. Legally permitted, mathematically significant, philosophically contested. 250,000 self-employed citizens structurally excluded from the main retirement system, a coverage gap that most OECD pension systems closed decades ago. None of this makes CPF wrong. It makes CPF Singaporean. Precisely, deliberately, irreplicably Singaporean. It works here because of a combination of factors that cannot be separated from each other. Limited land, exceptional governance track record, intergenerational institutional trust, and a population that found the trade-offs acceptable because the alternative in one of the most expensive cities on earth is to build your retirement from scratch with no state infrastructure at all. The people who built CPF knew exactly what they were trading away. Personal freedom over capital allocation. Competitive market returns on retirement savings. Immediate access to earned wages. They traded all of it for certainty, for a home ownership model that gave almost every Singaporean a paid-off roof at 65, for a healthcare floor, and for a population that would not arrive at retirement with nothing. Whether that specific trade was worth it is not this video's answer to give. That question belongs to you. Rajan finishes his kopi C. The hawker center is filling up around him. He puts his phone on the table and opens the CPF website. He checks his accrued interest figure. He checks his SRS balance. He looks at his retirement account projection for 65 versus 70. He does one thing. He sets up the maximum SRS contribution for the year, $15,300, scheduled for January 2nd, so the full year of returns begins immediately. He has already chosen VWRA. He made that decision months ago. He just never pressed confirm. He presses confirm. $2,983 less in tax this year. Market returns on $15,300 from January. No CPF board approval required. No waiting until 55. No accrued interest to calculate when he eventually sells. His. The CPF he cannot change. The decisions around it, those are entirely within his control. The system is not a cage, if you understand what the walls are made of. Most people spend their whole careers looking at the locked door. The ones who retire comfortably spend their careers building the door beside it. Which one are you building right now? And tell me this. When did you last actually open your CPF statement and check whether your current trajectory lands above or below the basic retirement sum? Leave your answer in the comments. I read every single one. If this video changed how you see the system, subscribe. The next video covers what happens to your CPF when you die, and most people get the rules completely wrong.